The Fed is not cutting rates right now. And Fed Chair Powell said he's not cutting interest rates because he's expecting inflation to rise over the summer because of tariffs. That might kind of make sense. I mean, I'd say if someone said that to me, I'd say I understand that prices should be going up because of tariffs. But that is not actually how monetary policy should be administered. The Fed is really supposed to overlook supply shocks. So if you have a supply shock, like a tax, and it causes a one-time rise in price.
BitcoinZella stands out with its simplicity and clarity. We've crafted an experience that anyone can dive into, whether you're a crypto expert or just a new to the crypto world. Now guess who keeps his eye on us? The author of best-selling book Rich Dad Poor Dad, Robert Kiyosaki. And we want to take this opportunity and thank all the people who trusted us, and we read every comment. And the best part, it's free. Subscribing now means you will get all new information for free. Don't just follow the trends, stay ahead of them. Subscribe to BitcoinZella today and enjoy the new edge. Tom Lee talks U.S. stock strategy and crypto trends. What's next for markets? Big moves ahead? Let's dive in and see.
The central bank is not supposed to adjust monetary policy for that because the Fed is trying to control demand, meaning if there's so much demand for something that it causes prices to go up, they try to tighten monetary policy. But because of tariffs is more like a supply shock, the Fed should actually look through it. The bond market is starting to make that conclusion. On Wednesday's FOMC meeting, the bond market disagreed with the Fed. Interest rates actually went down in the last couple of days because they don't believe the Fed should be on hold. And that's also been our argument that the Fed, if they're not cutting now, they have to do more cuts next year. Maybe more importantly, most people think stock rallies are only because the Fed is easing, adding liquidity. That's why in the April lows, people were saying the stock market couldn't rebound because the Fed wasn't going to add liquidity. But guess what? We had a V-shaped bounce anyways. And so it shows you the central bank isn't needed for stocks to rally. But next year, we think they're going to cut a lot, and that should support stocks.
Robert Kiyosaki, the best-selling author of Rich Dad Poor Dad, has stirred up fresh conversation in the crypto world with his latest post on X known for his bullish stance on Bitcoin. Kiyosaki didn't hold back, saying he actually hopes Bitcoin crashes. Why? Because he wants to buy more. While many investors panic at the thought of a price drop, Kiyosaki sees it as a golden opportunity. In his words, only clickbait losers are pushing the idea of an upcoming crash just to scare off speculators. But if it happens, he's ready to swoop in and stack more BTC for himself. He's long warned about the weakening US dollar and growing national debt, pointing out that the dollar has lost about 95% of its purchasing power since he was in his 20s. To him, Bitcoin isn't just an investment, it's a hedge against the system. Kiyosaki is confident that Bitcoin will soar far beyond its current levels. He's predicted it could hit $1 million in the next decade and even backs Michael Saylor's wild forecast of $13 million per coin. As Bitcoin trades around $108,000 today, down slightly from $110,000, Kiyosaki isn't phased. For him, dips or discounts, not disasters.
The stock market in 2025 faced a black swan because Tariff Liberation Day was a shock, and it created a downward spiral in stocks, falling 20% in the fastest pace, or one of the fastest pace in 100 years. There have only been 12 times in history that stocks fell a similar amount and a similar speed. And I think the mistake many people made was that shock turned people bearish. As you mentioned, we did think there would be a correction this year, but the reason I think we didn't turn bearish, even though this was a huge decline, is three things. One, we didn't expect President Trump to stick with the tariff terms. So even though in the beginning they claimed this was the deal and everyone had to take it, we thought they would eventually walk back those terms, which is what's happened. And in fact, what we've seen so far is the tariffs are much, much milder than many people thought at the start of the year. So we're actually in a better place. The second is many economists convinced you that there'd be a recession. Do you remember all these economists said a recession's guaranteed? And that's why everybody panicked and sold their stocks. But we don't necessarily listen to economists. We prefer to watch what the high yield market is doing. And the high yield market, while it showed some turbulence, actually moved in a way that said there might be a growth scare. So there's a difference between a growth scare and a recession. A growth scare just means everybody gets cautious, which is understandable. And the third reason we didn't turn bearish is that waterfall declines, like we saw, usually come back as a V-shaped recovery. And that was our argument, that this would be a V-shaped bounce. And in fact, we were pretty convinced of it because the VIX, which is a measure of volatility, jumped to 60. And if you look at the last 35 years, anytime the VIX has moved above 60, no matter what you think, you have to buy the stock market because that's pure terror. The market is so scared, they're not pricing anything, and that's why you have to buy that. And so stocks had a V-shaped bounce. And now that we're almost back to the old highs, I'm finding a lot of people are still bearish. Maybe in the audience, you guys are still bearish, thinking, I don't see why stocks came back, so I don't really want to buy the stock market now. But here's something to keep in mind. In 2025, we've already had a 20% decline. The chances of a 10% decline between now and year end is very low. It might even be statistically 0%. So maybe the stock market could trade sideways for a little bit, but the chances of us declining again are very low.
Bitcoin's price has taken a surprising dip, falling to $107,400 even after spot Bitcoin ETF saw a massive $1 billion inflow. You'd expect that kind of institutional interest to boost prices, right? But instead, the market reacted in the opposite direction. One of the biggest reasons behind the pullback seems to be growing anxiety around the U.S. economy and a mysterious shift in old dormant Bitcoin wallets. On Thursday, Bitcoin faced resistance near $110,500, only to drop by nearly 2.8% the next day. This came right after a wave of fresh ETF investments, which usually signals strong buying confidence. But macroeconomic fears are starting to creep in. Concerns about U.S. fiscal deficits, rising tariffs, and the possibility of a global trade war are making investors more cautious. When uncertainty in the traditional economy rises, even crypto isn't immune. Adding fuel to the fire, an old wallet holding 80,000 BTC suddenly moved its coins after being silent since 2011. That spooked the market. People feared a massive sell-off even though on-chain analysts believe a sale is unlikely. Historically, these kinds of dormant wallet movements don't lead to major trend reversals, but they do trigger short-term fear. Right now, Bitcoin's weakness seems more tied to global economic jitters than anything happening on the blockchain. If you've been with us so far, a big thank you. Don't forget to subscribe for free to BitcoinZella for your daily news. The link is waiting below. That's all for today's crypto news. Stick around for more updates, insights, and analysis on cryptocurrencies. Share your thoughts in the comments, like this video, and subscribe for more exciting content.